Good morning. We need to talk about silver, not because of internet hype, not because someone on social media told you to buy, but because something fundamental is shifting in one of the world's oldest monetary metals. Silver prices have captured attention recently. Retail investors are entering the market in numbers we haven't seen in years. Analysts at major institutions are publishing price targets that would have seemed absurd just months ago. Some are predicting silver could reach $100 per ounce. That's roughly 3 times current levels. Now, before you dismiss this as speculation or rush to make decisions, let me be clear about what this video will and won't do. This isn't a get-rich-quick presentation. We won't be making guarantees or promising overnight wealth. What we will do is examine the forces at play with the same rigor you'd expect from a trusted financial advisor. Because here's what matters. Whether you currently hold silver, are considering entering the market, or simply want to understand what's happening in precious metals, you need clarity, you need context, and you need to understand both the opportunity and the very real risks involved. The silver market is complex. It sits at the intersection of monetary history, industrial demand, and investment psychology. It's influenced by everything from inflation expectations to technological trends in solar panels and electric vehicles. And right now, several of these forces are aligning in ways we rarely see. So let's approach this the way serious investors should, with intellectual honesty, historical perspective, and a clear-eyed assessment of what the data actually tells us. By the end of this discussion, you'll understand what's driving current silver dynamics. You'll know how to think about position sizing if you're considering exposure, and you'll recognize the critical mistakes that cause investors to lose money even in genuine bull markets. Let's begin. Silver occupies a unique position in financial markets. It's neither purely an industrial commodity nor strictly a monetary metal. It's both. This dual nature creates complexity, but it also creates opportunity for those who understand it. On one hand, roughly half of silver demand comes from industrial applications, electronics, solar panels, medical devices, water purification systems. The global economy consumes silver as a raw material. This means silver prices are influenced by economic growth, manufacturing activity, and technological trends. When economies expand, industrial silver demand typically rises. On the other hand, silver has served as money for thousands of years. It remains a store of value, a hedge against currency debasement, and a safe haven during periods of financial uncertainty. This means silver prices also respond to monetary policy, inflation expectations, and investor confidence in the financial system. Understanding this duality is essential. It explains why silver can behave differently than gold, why it's more volatile, and why its price trajectory can surprise even experienced investors. Let's examine what's actually happening right now. Retail demand for physical silver has increased markedly. Coin sales from major mints are running well above historical averages. Dealers report inventory constraints. Premiums over spot prices have widened significantly. This isn't speculation. These are observable facts in the physical market. Simultaneously, we're seeing institutional interest return. Exchange-traded funds focused on silver have experienced net inflows. Options activity has increased. Futures positioning suggests growing conviction among professional traders. The supply side tells an equally important story. Global silver mine production has been essentially flat for years. Unlike gold, where miners can relatively easily increase output when prices rise, silver faces structural challenges. Most silver comes as a byproduct of mining other metals, particularly copper, lead, and zinc. This means silver supply doesn't respond quickly to price signals. When demand surges, the market can't simply produce more metal overnight. We also need to consider above-ground stocks. While precise data is difficult to obtain, analysis suggests that readily available silver inventories relative to annual demand are lower than they've been in decades. Add to this the industrial demand trends. Solar panel installation is accelerating globally as countries pursue renewable energy targets. Each panel requires silver. Electric vehicles use more silver than traditional combustion engines. 5G infrastructure build-out requires silver. These aren't temporary phenomena. They represent structural shifts in how the global economy uses this metal. Now let's talk about the monetary backdrop, because this matters enormously. Over the past several years, we've witnessed unprecedented monetary expansion. Central banks around the world injected trillions of dollars into the financial system. Money supply growth reached levels not seen in peacetime history. The immediate inflationary impact was delayed by various factors. But inflation eventually emerged, reaching multi-decade highs in many developed economies. Central banks responded by raising interest rates aggressively. This tightened financial conditions. It slowed inflation. But it hasn't eliminated the underlying concern about currency purchasing power. Here's what you need to understand. Precious metals, including silver, have historically served as a hedge against currency debasement and loss of purchasing power. Not perfectly, not in a straight line, but over extended periods, silver tends to maintain its purchasing power when paper currencies do not. Current monetary conditions remain highly unusual by historical standards. Real interest rates, adjusted for inflation, are still relatively low in many jurisdictions. Government debt levels continue to climb. The long-term fiscal trajectory of major economies raises legitimate questions about currency stability. This creates a backdrop where hard assets, tangible stores of value, become more attractive to certain investors. Let's put current conditions in historical perspective. Silver has experienced several major bull markets in modern history. In the late 1970s, silver rose from around $4 to over $50 per ounce. In 2011, it again approached $50 during the aftermath of the financial crisis. Both episodes ended badly for late entrants. Both created cautionary tales about volatility and timing, but both also reflected genuine underlying forces: monetary instability, inflation concerns, and loss of confidence in the financial system. The question isn't whether silver can reach extreme prices. History proves it can. The question is whether current conditions justify sustained higher prices and how to navigate the journey. One important observation: silver bull markets typically don't occur in isolation. They generally coincide with broader concerns about the financial system, currency stability, or economic uncertainty. We need to ask ourselves, are those conditions present today? The answer is nuanced. We're not in a crisis comparable to 2008. But we are navigating a complex transition from an era of extremely loose monetary policy to something more normal. We're dealing with geopolitical tensions. We're watching debt levels that would have seemed inconceivable a generation ago. These aren't reasons to panic, but they are reasons to maintain diversification and consider how different asset classes might perform in various scenarios. Now let's address the elephant in the room: retail investor psychology. When retail investors flood into any market, it creates a complex dynamic. On one hand, it represents real demand that can drive prices higher. On the other hand, retail participation often peaks near the end of bull markets, not the beginning. Current retail interest in silver shows some warning signs, but also some encouraging differences from past episodes. The warning signs: social media promotion, simplified narratives about manipulation and short squeezes, and a focus on rapid gains rather than fundamental value. The encouraging differences: broader awareness of inflation risks, genuine concerns about monetary policy, and increasing recognition of silver's industrial importance. Sophisticated investors recognize that retail participation is a double-edged sword. It can fuel price momentum, but it can also create volatility and eventual corrections when sentiment shifts. This is why emotional discipline matters so much. The investors who profit from commodity cycles aren't necessarily the ones who buy first. They're the ones who manage risk properly, size positions appropriately, and avoid the behavioral mistakes we'll discuss later. Let's think seriously about the $100 price target some analysts are discussing. For silver to reach that level from current prices would require specific conditions to emerge and persist. First, industrial demand would need to remain strong or accelerate. The green energy transition would need to continue driving structural consumption growth. Second, investment demand would need to increase substantially. This could happen through safe haven buying during geopolitical uncertainty, inflation hedge positioning, or simply momentum-driven allocation. Third, supply would need to remain constrained or grow more slowly than demand. Given the structural challenges in silver mining, this is plausible. Fourth, and perhaps most importantly, we'd likely need to see a broader awakening to precious metals across the investment community. Institutional allocators would need to meaningfully increase their exposure. Is this scenario possible? Yes. Is it guaranteed? Absolutely not. Markets are complex systems influenced by countless variables. Predicting specific price levels is an exercise in hubris, not analysis. What we can say is that the conditions for a sustained silver bull market appear more favorable than they've been in years. But favorable conditions don't eliminate risk. They don't justify reckless position sizing. And they certainly don't guarantee outcomes. We must address volatility explicitly because it's a defining characteristic of silver markets. Silver is substantially more volatile than gold. It's more volatile than most equity indices. This volatility cuts both ways. During bull markets, silver can outperform dramatically. It's not unusual to see silver rise 50 or 75%, while gold rises 25% in the same period. But during corrections, silver can fall just as dramatically. Sharp 20 or 30% pullbacks can occur in weeks. These corrections test investor resolve and force out weak hands. Why is silver so volatile? Part of it is market size. The silver market is smaller than gold, smaller than major equity markets. Smaller markets are inherently more volatile because large flows have outsized impacts. Part of it is the dual nature we discussed earlier. Silver responds to both industrial and monetary factors, creating more complex price dynamics. And part of it is investor psychology. Silver attracts momentum traders and speculators who amplify price swings in both directions. Understanding this volatility is essential for position sizing. An appropriate position in silver for most investors is not the same as an appropriate position in a diversified equity fund. If a 25% drawdown would cause you to sell in panic, your position is too large. If you can't emotionally handle significant volatility, silver may not be appropriate for your portfolio at all. This isn't a weakness in you as an investor, it's self-awareness, which is one of the most valuable traits in finance. Let's speak directly to those who already own silver. You're facing a different set of decisions than potential new investors. If you've held silver for years, you may be sitting on substantial gains. Congratulations. Now comes the hard part, deciding what to do. One option is to take partial profits systematically. This doesn't mean selling everything. It means reducing your position incrementally as prices rise. Consider establishing price levels in advance where you'll sell a specific percentage of your holdings. This removes emotion from the decision. For example, you might decide to sell 20% of your position at $40, another 20% at $50, and so on. The specific levels matter less than having a plan you've committed to before the heat of the moment. This approach ensures you realize some gains. It reduces your exposure if prices reverse, and it allows you to maintain participation if prices continue rising. The psychological benefit is enormous. You've locked in profits. You can't lose everything if the market turns, yet you haven't completely abandoned a position in an asset that may continue appreciating. Another critical consideration is portfolio balance. If silver has appreciated significantly, it may now represent a much larger percentage of your wealth than originally intended. This concentration creates risk. Suppose silver was initially 5% of your portfolio, but has tripled while other assets remained flat. Silver might now represent 12 or 15% of your holdings. This isn't necessarily wrong, but it changes your risk profile. You're now more exposed to silver-specific risks, industrial demand shocks, monetary policy shifts, or simple sentiment changes. Rebalancing back to your target allocation is a legitimate strategy. It forces you to sell high and buy assets that haven't appreciated as much. This feels counterintuitive. Selling winners and buying laggards goes against our instincts, but it's a disciplined approach that prevents any single asset from dominating your financial future. As an existing holder, you're also facing a philosophical question. Are you a momentum investor or a value investor in silver? Momentum investors ride trends. They hold as long as price action remains positive. They use technical indicators and price patterns to guide decisions. Value investors focus on fundamental worth. They assess whether current prices reflect genuine value or speculative excess. They're willing to sell into strength even if momentum suggests further gains. Neither approach is inherently superior, but you need to know which one guides your decisions. If you're a momentum investor, establish clear exit signals. What price action would tell you the trend is over? What technical breakdown would trigger a sale? If you're a value investor, what's your assessment of fair value? At what price does silver become overvalued relative to industrial fundamentals and monetary conditions? Clarity on this question prevents paralysis and second guessing during volatile periods. For sophisticated investors, option strategies can protect gains while maintaining upside exposure. Purchasing put options gives you the right to sell silver at a predetermined price. This acts as insurance against significant declines. The cost is the premium you pay for the option. But for investors with substantial gains, this cost may be worthwhile protection. Alternatively, selling covered calls generates income while capping upside potential. You agree to sell your silver at a higher price if it reaches that level, collecting premium income for this agreement. These strategies aren't appropriate for everyone. They require understanding of options mechanics and careful consideration of tax implications. But for investors with large positions accumulated at much lower prices, options can provide flexibility that simple holding or selling doesn't offer. Finally, let's consider the long-term hold perspective. Some investors view silver as multi-generational wealth preservation. They're not trying to time markets or maximize short-term gains. They're holding physical metal as a hedge against systemic risks and currency debasement. If this describes your approach, current price fluctuations may be largely irrelevant. You're not selling at $40, $50, or even $100 per ounce. This is a legitimate strategy, particularly for a portion of your holdings. But be honest with yourself about whether you can actually maintain this discipline. It's easy to claim you're a long-term holder when prices are rising. It's much harder when you watch silver fall 30% in a correction and wonder if you should have sold. If you're genuinely committed to long-term holding, consider physically separating this portion from the rest of your investments. Make it psychologically difficult to access. This reduces the temptation to make emotional decisions during volatility. Now, let's address those considering entering the silver market. Your situation requires different thinking. The most common question from potential investors is simple: is now a good time to buy? The honest answer is that nobody knows with certainty. Anyone claiming to know is either deceiving you or deceiving themselves. What we can do is assess current conditions relative to historical patterns and fundamental factors. Silver is not at all-time highs. It remains well below the $50 levels reached in 1980 and 2011. Even accounting for inflation, current prices are not extreme by historical standards. Industrial fundamentals appear supportive. Investment demand is rising but hasn't reached mania levels. Supply remains constrained. Does this mean prices can't fall from current levels? Of course not. Markets can and do decline even when fundamentals appear supportive. The solution to timing uncertainty is position sizing and dollar cost averaging, which we'll discuss shortly. If you're new to silver, how much should you allocate? For most investors, precious metals, including silver, should represent a relatively small portion of total portfolio value. 5 to 15% is a common range, depending on your age, risk tolerance, and overall financial situation. Within precious metals allocation, silver is typically more volatile than gold. This suggests an initial position in silver might be smaller than your gold position if you hold both. A reasonable starting point might be 3 to 5% of your total portfolio in silver. This is large enough to matter if prices rise significantly. It's small enough that you won't be financially devastated if prices fall. Remember, the goal isn't to get rich from silver. The goal is to achieve appropriate diversification while managing risk. If you find yourself thinking that silver is your path to wealth, you're approaching this incorrectly. That mindset leads to oversized positions and emotional decision-making. Rather than investing your entire intended allocation immediately, consider dollar cost averaging over several months. This means buying equal amounts at regular intervals regardless of price. Perhaps you invest 20% of your intended position each month for 5 months. This approach has several benefits. First, it reduces timing risk. You're not betting everything on a single entry point. Second, it averages your purchase price across different market conditions. You'll buy some silver at lower prices, some at higher prices. Third, it allows you to learn about the market as you build your position. You'll experience volatility before you're fully invested. This emotional education is valuable. Fourth, it provides discipline. You've committed to a plan that removes the constant question of whether to buy now or wait. The downside is that if prices rise steadily, you'll pay higher average prices than if you'd bought everything immediately. But given the uncertainty about short-term price movements, this is a reasonable trade-off for reduced risk. You need to decide between physical metal and paper instruments like exchange-traded funds or mining stocks. Physical silver means coins, bars, or rounds that you actually possess or store securely. This provides direct ownership of metal, no counterparty risk, no management fees. But physical silver has drawbacks: storage and security concerns, lower liquidity, wider bid-ask spreads, premiums over spot price that can be substantial. Paper silver, through ETFs, offers convenience and liquidity. You can buy and sell instantly, no storage concerns, tight spreads. But paper silver means trusting the fund structure and counterparties. You own shares representing silver, not the metal itself. Silver mining stocks provide leverage to silver prices. When silver rises, profitable miners often rise more. They also offer dividends and growth potential. But mining stocks carry company-specific risks unrelated to silver prices. Management decisions, geological challenges, political risks in mining jurisdictions. For most investors, a combination makes sense. Perhaps 50 to 70% in an ETF for liquidity and convenience, 30 to 50% in physical metal for direct ownership, possibly a small allocation to quality mining companies for growth potential. The right mix depends on your priorities and circumstances. When buying physical silver, understand that the price you pay includes more than the spot price. Premiums over spot can range from 5 to 20%, depending on product type and market conditions. Coins typically carry higher premiums than bars. Storage costs money if you use professional vaulting. Insurance costs money if you store at home. When you sell, you'll face the bid-ask spread. Dealers buy it below spot and sell at above spot. These costs are real. They mean silver prices need to rise meaningfully before you actually profit. Calculate your total cost and break-even point before investing. This prevents disappointment and ensures realistic expectations. Before investing significant capital in silver, invest time in education. Understand how silver is priced. Learn about the futures market, even if you won't trade futures. Comprehend the difference between spot price and physical premiums. Study historical price patterns. Understand what drove previous bull markets and what caused them to end. Research storage options if buying physical metal. Understand tax implications in your jurisdiction. This education might take weeks or months. That's fine. The market will still be there. Better to enter informed than to rush in and make expensive mistakes. Knowledge compounds. Every hour you spend learning about silver markets will serve you for years as you make better decisions. Let me be very direct about the mistakes that cause investors to lose money even in genuine bull markets. The single most destructive mistake is using leverage or margin to amplify your position. The temptation is understandable. If you believe silver will double, why not use borrowed money to double your potential profit? Because Leverage works in both directions. A 20% decline in an unleveraged position is painful. The same decline in a leveraged position can wipe you out entirely. Silver's volatility makes leverage especially dangerous. A sharp correction that would merely test the discipline of an unleveraged investor can force margin calls and permanent losses for a leveraged one. I cannot emphasize this strongly enough. Do not use leverage for silver investments. Do not use margin. Do not borrow money to buy precious metals. If your position is too small without leverage to achieve your goals, that's a sign your goals are unrealistic, not a reason to borrow. Emotions destroy returns in volatile markets. Fear causes investors to sell at bottoms. Greed causes them to buy at tops. Hope causes them to hold losing positions too long. Pride prevents them from admitting mistakes. The antidote is having a plan before emotions run high. Decide in advance what percentage gain would cause you to take profits. Decide what percentage loss would cause you to exit. Write these down. Commit to them. When the time comes, your decision is already made. You're just executing a plan, not making an emotional choice in the heat of the moment. This doesn't mean being inflexible. If fundamental conditions change dramatically, you can revisit your plan, but you should never make decisions based on fear or greed in the moment. Another critical mistake is chasing performance after silver has already moved significantly. The psychological pattern is predictable. Silver rises 20, 30, 40%. Media coverage increases. Friends and family start talking about it. You feel like you're missing out, so you buy at elevated prices, right when smart money might be taking profits. Then prices correct, as they inevitably do in volatile markets. You panic and sell at a loss. This pattern repeats across markets and throughout history. Don't be another example. If you believe in silver's long-term potential, establish a position at a measured pace, regardless of recent price action. If you're only interested because prices have risen, examine your motivations carefully. Some investors become so convinced of silver's potential that they abandon diversification entirely. They concentrate 50, 70, even 90% of their wealth in silver. They're certain they've found the answer to wealth building. This is catastrophically risky. No matter how compelling the silver story seems, you cannot know the future. Unexpected events occur. Fundamental factors change. What seems certain becomes questionable. Concentration might generate exceptional returns if you're right, but the cost of being wrong is financial devastation. Diversification is your protection against what you don't know and can't predict. It's not a constraint on returns. It's the foundation of long-term wealth preservation. The internet has created a new class of precious metals promoters and influencers. Some provide valuable education and analysis. Many do not. Some have conflicts of interest they don't disclose. They're compensated by dealers for directing buyers. They profit from increased trading volume. They're selling courses or subscriptions. Others simply lack expertise. Enthusiasm and confidence aren't substitutes for knowledge and experience. Be extremely skeptical of anyone promising specific price targets or guaranteed returns. Be wary of those claiming secret knowledge or manipulation theories that only they understand. Trust your own analysis. Verify claims independently. Remember that if someone truly had a foolproof path to wealth, they'd be quietly executing it, not selling you courses about it. Precious metals have specific tax treatments that vary by jurisdiction. In many locations, gains on physical precious metals are taxed as collectibles at higher rates than long-term capital gains on stocks. Some jurisdictions charge sales tax on purchases. Others don't. Failing to understand these implications can significantly reduce your actual returns. Consult with a qualified tax professional before making substantial investments in silver. Structure your holdings in tax-efficient ways where possible. What seems like a great investment decision can become mediocre after considering taxes. Finally, recognize that corrections are normal and inevitable. Silver will not rise in a straight line. Even in the strongest bull markets, there are sharp pullbacks that test investor conviction. These corrections serve a purpose. They shake out weak hands. They reset sentiment. They create opportunities for disciplined investors to add to positions. If you sell during a correction out of panic, you crystallize losses and miss the recovery. This is why position sizing matters so much. If your position is appropriately sized for your risk tolerance, you can weather corrections without panic. If every 10% pullback makes you question your entire thesis, your position is too large. We've covered substantial ground. Let's bring this together with final thoughts. Silver is experiencing dynamics that merit serious attention. Rising retail demand, constrained supply, industrial growth trends, and monetary conditions are creating a potentially supportive environment. Price targets of $100 per ounce are not absurd fantasies. They're plausible outcomes if specific conditions emerge and persist. But plausibility is not certainty. Possibility is not probability. The path forward will include volatility, corrections, and periods of doubt. It will test your discipline and emotional control. Your success will depend less on market timing and more on risk management, less on predicting specific prices and more on positioning appropriately for various scenarios. If you currently hold silver, you have decisions to make about taking profits, rebalancing, and protecting gains. Think clearly about your goals and time frame. Execute a plan rather than reacting emotionally. If you're considering entering the market, start with appropriate position sizes. Use dollar cost averaging to reduce timing risk. Invest in education before investing significant capital. For everyone, remember these principles. Diversification protects you from what you don't know. Position sizing determines whether volatility is manageable or catastrophic. Emotional discipline separates successful investors from cautionary tales. Leverage and margin are dangerous tools that can destroy wealth regardless of whether you're directionally correct. Having a plan before emotions run high is essential. The goal isn't to get rich from silver. The goal is to achieve appropriate exposure to an asset class that may perform well in certain economic environments while managing downside risk. Silver is neither a guaranteed path to wealth nor a foolish speculation. It's a legitimate portfolio component that requires the same thoughtful approach as any investment. The investors who navigate the next phase of the silver market successfully will be those who maintain perspective. They'll size positions appropriately. They'll resist the temptation to overtrade or overleverage. They'll make decisions based on analysis rather than emotion. They'll recognize that building and preserving wealth is a marathon, not a sprint. Whatever you decide about silver, make those decisions deliberately, with full awareness of risks, with realistic expectations about potential outcomes. The markets reward patience and discipline. They punish impatience and greed. Approach this opportunity with the seriousness it deserves, not with fear, but with respect for the complexity involved. Do your homework. Size positions appropriately. Have a plan. Execute with discipline. That's how you navigate uncertain markets successfully. That's how you protect yourself from the mistakes that destroy returns. And that's how you position yourself to benefit from genuine opportunities when they arise. The silver market will continue to evolve. New information will emerge. Conditions will change. Stay informed. Stay disciplined. Stay rational. Your financial future depends not on predicting what silver will do, but on how you respond to whatever actually happens. Thank you for your time and attention. Invest wisely.